Now, this wouldn't be a complete small business academy without at least mentioning business taxes and tax compliancy. Now, I do want to say that I have a mini course that goes over taxes more in depth, but I did just want to make note of tax compliancy and your requirements as a business owner. So tax compliance refers to the act of obeying and following the rules and regulations set forth by the government regarding the payment of taxes. It involves accurately reporting income, deductions, and other relevant information to the government, as well as submitting tax returns and paying any taxes owed in a timely manner. Tax compliance is important for both individuals and businesses, since failure to comply with tax laws can result in penalties, fines, or even legal action. It's essential to maintain accurate records and stay up to date with changes in tax laws and regulations to ensure full compliance. Now, many of us have seen on the news, I don't know if you're my age, but you see these big wigs that the federal government have been trying to put away for years, and they get them on tax compliancy. And I'm talking about the John Gottis of the world, right? So you really have to pay attention to what you're doing with taxes and how you're managing your taxes, because the IRS, the government, does not play. They want to get paid, and nothing is going to stand in their way of getting paid. And you have to remember that, right? So you have to make sure that you are aware of the tax requirements for your state. Now, federal tax requirements are obviously going to be the same for everybody, but there are state taxes, and then there's also state fees. So in California, I have to pay state taxes on top of my federal taxes, but I also owe my state a fee every year, and this fee is $800 per business. So if you haven't started your business already, I highly recommend you call your local small business office, call your local state office, and find out what resources they have. Check out their website and get an idea of what your requirements are going to be as a small business owner. Because for me, with an $800 fee every year, I now have to embed that tax fee into my overhead costs. So I have to make sure that I'm generating enough revenue to cover all of my fees. And obviously some taxes are going to be based on your income, so there really isn't much you can do about that, but it's important to know. So next we're going to talk about the different types of business taxes and just some terminology that I think you should be aware of. Let's go over some terminology that will help you do some research into determining what your specific tax requirements are based on your state and your business type. And again, I do have a business tax mini course that goes more in depth, especially if you're in e-commerce. E-commerce is kind of a gray area when it comes to taxes, because you can be providing products to anywhere in the United States. So you might actually have to pay taxes in other states. But let's get into some of the key terminology that I think you should know as a business owner, starting with your tax filing deadlines. The IRS has specific deadlines for filing various types of business tax returns, including your income tax returns, payroll tax returns, and information returns. Now, your business structure is also going to affect your tax liability and your tax deadlines. For example, a sole proprietorship reports business income and expenses on a Schedule C attachment to your personal income tax return, while a corporation files its own tax return. It's important to choose the right structure for your business to minimize your tax liability. Now, if you're a single member LLC or a sole proprietorship, you're going to file your business tax return with your personal tax return. So the Schedule C is a form, and this form just goes at the end of your regular tax return, your 1040 or whatever you're filing. Now, this deadline is going to be the same as your personal taxes, so around April 15th. Whereas if you're a partnership or a corporation, your tax deadline is usually around March 15th. And over the last few years with COVID and everything else like that, tax deadlines have been changing, but as of right now, those are the general deadlines. Now, deductible business expenses. So certain business expenses are deductible on your tax return, including rent, utilities, supplies, and employee salaries. Keeping track of these expenses can help reduce your taxable income. So when you're categorizing your expenses, this is the real reason why you're doing it. Yes, it's to help, fill out your P&L, but also because you need to see what exactly you can deduct, or your accountant needs to see what they can deduct. Now, not all business expenses are tax deductible, but a lot of them are. And I go through this more in the business tax course that I've mentioned. Now, as an employer, you are required to withhold and pay certain taxes on behalf of your employees, including Social Security and Medicare taxes, federal income tax, and state income tax where applicable. So I did want to touch on this just a little bit. Now, if you hire yourself as an employee, so if you W-2 yourself, you will have half of the tax obligation. And this is how it works across the board. So if you have an employee who's a W-2 employee, you are required to pay half of the taxes required for that employee. So overall, each employee has to pay 15.3% in taxes. If you W-2 them, the employee, pay, the 7.6% in taxes, and you pay the other 7.6%. So you split the responsibility. And that's the same for you. If you're a sole proprietor and you are, earning your profits as your income, you're going to have to pay 15.3% in taxes. And I'm going to break that down a little bit further. Every employee has to pay 15.3% in taxes. If you are a W-2 employee, or if you make your employee a W-2, including yourself, now you split the tax responsibility. So the employee pays half, you pay the other half. The same goes for you as the owner. So if you're a sole proprietor paying yourself, you have to pay 15.3% in taxes. But if you W-2 yourself, you as the quote-unquote employee only has to pay the 7.6 and the business pays the other 7.6. And you're probably thinking, but I own the business. And that's okay. What that means is the business gets to pay that 7.6%, but employee taxes are tax deductible. So yes, your business pays 7.6, but then at the end of the year, your business writes that off. So at the end of the day, you're only paying 7.6% in taxes if you hire yourself as a W-2 employee. Now, if you have employees and you're paying them, they're going to pay the 7.6%. You don't have to worry about that. And the business gets to write off the 7.6% that you're required to pay. I know that might be a little confusing, but that is the general basis of employee taxes. Let's talk about depreciation. So if you own a business property, you may be able to deduct the cost of the property over a period of years through depreciation deductions. Now, this is not just for business properties. This can go for electronics as well. So if you purchase let's say a laptop in 2020, and that laptop has a life expectancy of 5 years. So the laptop, let's say, was $1,000. That means every year for the next 5 years, that laptop is going to depreciate by $200. So you get to write off that depreciation value. So basically, by the end of that 5 years, you would have written off the entire cost of that product. Next are estimated taxes. So if you expect to owe more than a certain amount in taxes each year, you may need to make quarterly estimated tax payments to the IRS to avoid penalties. This is actually not a bad thing. The IRS is never going to turn down money. So if you wanted to pay taxes ahead of time, which a lot of businesses do, because you are concerned about not being able to meet your tax obligation, you can absolutely pay them early. It's not, like I said, it's not a bad thing. I would, however, wait because your deductibles can reduce your overall tax obligation. So I would definitely get with your CPA or your accountant to make sure that you are in the clear. Next will be sales taxes. So if you sell goods or service, you may be required to collect and remit tax to the state where the sale occurs. This is very important. This last piece is where the sale occurs. For example, I have an e-commerce site that operates out of California. I only have to pay taxes, sales taxes, on the sales made to residents in California. So I sell supplements. So if someone purchases, let's say, protein powder from me and they live here in California, let's say they live in Los Angeles, I have to pay taxes, sales taxes on that sale, and so does the customer. But now if somebody else purchases something from me, let's say someone in Florida, they don't have to pay California state taxes and I don't have to pay Florida taxes. So you have to look into that. It depends on each state. Here in California, California only makes me pay state taxes for the state of California, and I don't have to pay state taxes or sales taxes anywhere else. That's strictly for e-commerce sites. You want to make sure you look into that. Tax credits. There are several tax credits available to businesses, such as research and development credit and the work opportunity tax credit. Now, the research and development tax credit is phenomenal. And I would highly recommend looking into that. It doesn't matter what your business is. If you are looking to perfect the way something is done, and I'll give an example. This is a true story. So I was working with an individual who owns Lash Bar, and they're all over California. They do eyelash extensions and along with a bunch of other services. And what the owner found is that the glue that they were using to apply these eyelashes were irritating a lot of their customers. So what she did was she looked into the glue, and she actually started to develop her own organic, like natural glue that was just as strong as the synthetic glue, but it wasn't irritating her customer's skin. Now, all of the cost that went into her researching and developing this product, getting prototypes, finding manufacturers who are actually able to create this compound, because she's not a scientist by nature, so she has to go and find these individuals, but all of that cost was given back to her as a tax credit. So everything she paid to develop this glue was, essentially given back to her with her taxes. So I would definitely look into that as well. It doesn't matter what your business is. If there's a process you can improve or a product you can improve, it's definitely worth looking into. And last is going to be tax audits. The IRS may audit your business tax return to ensure you are in compliance with tax laws. It's important to keep accurate records and be prepared for an audit if it does occur. So not everybody gets audited by the IRS. Sometimes this is done at random, especially if you have an extremely dense industry. So let's say there's a lot of these types of stores in your area, and the IRS is starting to look around and see maybe why. They're doing their own research, or maybe there was a mistake on your taxes, but it was a mistake that the IRS found questionable, so they're going to do some more research. I've never been audited, but I have been hired by companies who are currently going through an audit, and it's not always a bad thing. Honestly, audits can work one of two ways. Either the IRS finds that you owe them money, or the IRS finds that they owe you money, and you end up getting a check cut at the end of the audit. So again, it's not always a bad thing. Some people actually volunteer for audits if they believe that they're not getting enough money back. I don't recommend doing that unless you're extremely confident in the fact that you are owed money, but definitely something to look into. And to make sure that you are reviewing your taxes. So after your accountant puts your taxes together, I would highly recommend going through and making sure it makes sense to you before you sign it and have them file.